Big tech earnings have prompted my thinking about why AI matters for macro returns and which is more important to markets, AI or rate cuts. Clearly, they are pricing both in. Productivity and consumption are both falling this year. AI is supposed to help with that. Consumer spending has fallen this year despite the rosy 3% GDP print in the second quarter that the Trump administration is heralding. They don't parse it out to break down the trade data, but rather obscure the health of personal expenditures. As Eric Basmajian said, spending fell early in the year, bounced, and may now be heading lower again. He also added consumption plus investment, which is 87% of GDP, decelerated to 1.2% growth in second quarter. Heather Long, chief economist at Navy Federal and columnist at Washington Post, noted, "This is an economy running just above 1% if you strip out the trade noise." The above was reason enough for Powell to highlight as a reason not to cut rates, goods inflation. Add to that, inflation dampens consumer spending, not the other way around. Just like inflation raises yields, not the other way around. But it is the inflation in asset prices that attracts capital into markets, specifically the AI mania stocks, and out of everything else. I like this meme. And while consumer consumption is falling, AI growth is hoped to make up this shortfall. As per the U.S. Bureau of Economic Analysis, so far this year, AI CapEx, which we define as information processing equipment plus software, has added more to GDP growth than consumers' spending. Apollo was out with a chart last week that highlights a CBO estimate where AI could help the U.S. fiscal problem. If AI results in permanently higher GDP growth and permanently lower inflation, it could solve the U.S. fiscal problem. That is the hope. The reality is that consumer spending comprises 70% of GDP growth. So, is it any wonder the Trump administration is pumping both AI and crypto? Both help distract from the devaluation in USD to focus on the promise of future abundance, not scarcity. And that abundance means rising government tax receipts resulting from a rising U.S. stock market. And this is very helpful to offset profligate U.S. fiscal spending. Ergo, there is much incentive to keep the AI and crypto dreams alive. I would say place your bets, but clearly the market already has. Wednesday, July 30th, at the last FOMC meeting, the market sold off after Powell disappointed markets with a hawkish pause. Meta and Microsoft earnings popped it back up on AI enthusiasm. For the most part, the market has already priced in future rate cuts and front-run future AI revenues. There will be many battles, but AI is winning the war. That doesn't mean Powell will make it easier for markets or Trump, but Powell clearly had the second quarter GDP print number and composition before the 2:30 p.m. press conference post FOMC, when the Fed kept the rate unchanged as expected. We have 3 or 4 tenths of core inflation from tariffs. You could argue we are looking through goods inflation by not raising rates. Translation: tariffs are inflationary, and the current restrictive Fed policy is going to stick around for a while. Bowman and Waller dissented, advising a cut in rates. Both are in line for Powell's job. What could trip up Powell and his hawkish tone? Employment weakness. I warned my clients on July 30th, 2 days before the market sell-off and VIX spike of 22% on August 1st. You know what's going to suck for Powell after he pushed back hard on cutting rates? Friday's labor data. Maybe not this Friday, but some monthly NFP print or spiking jobless claims is going to come in super weak. Whether actual or manipulated, the blame game will get louder then. Imagine the Bloomberg headlines. When they pull this actual quote from Waller, Waller warned, "The job market underneath the surface is not doing well." When you start hearing cracks, it's too late. Jobless claims spike. Powell is punted, demoted, not fired. Waller vaults to the top of betting markets as new Fed head. Just something to keep in mind for bond traders into year end. And here's what's on my mind as counter to the unstoppable AI train that is sucking liquidity out of Main Street stocks and into the AI recession-proof ecosystem Wall Street stocks. That is a much bigger macro event risk than Powell punted or falling consumer health. You've heard of a debt jubilee, freeing individuals, businesses, and governments from debt. It has large moral hazards, such as creating disincentives for future lending, not to mention significant questions about fairness and who would ultimately bear the cost of debt forgiveness. Well, the AI tech jubilee is the fanciful creation of a future utopia where the path to solving hunger, disease, and poverty is AI and robotics. Elon Musk. But when it comes to how to distribute the power and benefits, the U.S. has a very different view view than China, for example. Irony, in the US, 50% of AI is currently monetized via gaming. Not stuff that makes Americans smarter, or richer for that matter, only 3% for productivity. Meta bets AI will generate cheaper, better, more targeted ads to its mostly non-business user base to justify its massive capital spending. Again, this doesn't make Americans smarter, or richer for that matter. CapEx growth is the trigger for higher valuations, and yet CapEx growers have historically underperformed. Make it make sense. But all of that pales in comparison to where I see so many US AI tech bulls missing the big picture. China is way ahead of the US in physical dominance, energy transition, education, and now AI tech dominance. As I wrote about post-DeepSeek, deep-sixing the semi-market in January, the US market just isn't willing to accept these facts. More than that, China doesn't see AI as a product. They see it as infrastructure, not winner takes all like Silicon Valley tech bros or Trump. Have a read of this thread with ex-Alibaba CTO interview snippets for color on what I mean. He explains in detail the difference between how the US and China view AI. And it is this winner-take-all hubris that is so dangerous to the US asset holders, big picture, as China's AI tech dominance quietly outpaces US assumed tech hegemony. So instead of Trump forcing sanctions and tariffs on China, making Americans poorer in the process, or running the stock market hot so as to ensure a sweep for midterm elections to further get the GOP behind a coordinated attack on China's supply chain, energy, and tech dominance over the U.S. How about we focus on the real problem at hand in the U.S., which is only made worse by this capital misallocation into AI tech? Before we work on artificial intelligence, why don't we do something about natural stupidity? Then I'd really be bullish. Subscribe, like, share for more deep macro, fundamental, and technical analysis research from LaDuc Trading. For actionable trade setups that support this research, join us live at www.laductrading.com.